In the first quarter of 2026, something fundamental broke in the global economic order. Not collapsed overnight, not announced in a single speech, but quietly crossed a point of no return. For decades, global trade was organized around a shared fiction, that efficiency, specialization, and mutual gain were the natural end state of economic cooperation. That fiction was known as the Washington Consensus, and it governed everything from supply chains to monetary policy. In Q1 2026, it stopped governing reality. What replaced it is not chaos, but something colder and more deliberate. Trade is no longer treated as an economic optimization problem. It is treated as a weapons system. Tariffs are no longer marginal policy levers designed to protect a sector at the edges. They have become the primary kinetic instrument of national strategy. Market access is now conditional. Supply chains are now political. Price stability is now subordinate to control. The numbers alone signal how radical the shift has been. As of early 2026, the effective tariff rate on imports into the United States stands at roughly 18%. After accounting for behavioral adjustments, substitution, and demand destruction, it still settles near 17%. That is not a modern figure. That is a pre-World War Roman II figure. The last time American consumers faced tariff pressure at this scale was during the Smoot-Hawley era of the 1930s, when trade policy actively amplified global economic fragmentation. This is not an accident of policy drift. It is the result of a deliberate philosophical reversal. Trade is no longer framed as a positive, some exchange that raises aggregate welfare. It is framed as a zero, some contest over industrial capacity, strategic leverage, and geopolitical alignment. The goal is not cheaper goods. The goal is leverage over who produces them, where they are produced, and under whose political supervision. The inflection point came with the so-called Liberation Day tariffs of April 2, 2025. These measures imposed near-universal duties and signaled a structural break from decades of trade liberalization. What began as an assertion of economic sovereignty quickly metastasized into retaliation, fragmentation, and inflationary pressure. By Q1 2026, the consequences are no longer theoretical. They are fully embedded in prices, logistics, labor markets, and financial flows. The legal architecture enabling this shift matters. Much of the escalation has occurred through executive authority under the International Emergency Economic Powers Act. This framework allows the President to impose sweeping trade measures in response to perceived national emergencies, bypassing traditional congressional oversight. The result is not just higher tariffs, but unpredictability. Firms cannot plan around a stable tariff schedule when rates can change overnight, justified by national security narratives rather than economic criteria. Within this system, the idea of reciprocity has been redefined. Officially, tariffs are framed as reciprocal responses to foreign trade barriers. In practice, they function as punitive instruments. China sits at the center of this strategy. By late 2025, the average U.S. tariff on Chinese goods had reached nearly 60%. In strategic sectors, the barriers are effectively exclusionary. Chinese electric vehicles face tariffs exceeding 140%, not to raise revenue, but to ensure they never enter the market at scale. This is containment by cost, by raising the price of access to the U.S. consumer market. The policy aims to sever the revenue streams that underpin China's industrial and military expansion. It is economic decoupling, executed through taxation, rather than embargo. Other countries experience a softer but still coercive version of the same logic. Vietnam provides the clearest example. Initially hit with a 46% tariff calculated through a blunt and controversial methodology, Vietnam negotiated its way down to a 20% reciprocal rate. The concession preserved access to the market, but at the cost of accepting permanent friction. A punitive 40% tariff remains in place for any goods deemed to be transshipped from China, turning Vietnam into both a beneficiary and an enforcer of the decoupling regime. A global baseline tariff of 10% now applies even to traditional allies. The European Union, Japan, and other partners operate under a universal assumption of friction. The message is clear: access to the American market is no longer a default condition of alliance. It is a privilege, priced and monitored. These tariffs do not land evenly. Commodity-level dislocations are severe. Metals, apparel, leather goods, and industrial inputs have seen short-term price increases approaching 40%. Even as supply chains adjust, long-run prices are projected to remain structurally higher than before. Strategic raw materials like copper experienced artificial scarcity after tariff hikes, distorting investment signals and tightening markets that were previously balanced. Semiconductors illustrate the internal contradiction of the strategy. Tariffs on legacy chips are intended to weaken foreign producers, but they also raise costs for domestic manufacturers downstream. Automakers, appliance producers, and medical device firms face higher input costs precisely as they are being asked to reindustrialize. The result is not a clean transition, but a system under strain. Trade has not disappeared. It has become politicized, fragmented, and more expensive. Efficiency has been displaced by resilience, not because resilience is cheaper, but because it is controllable. This is the new tariff era. It is not a temporary deviation. It is a structural realignment of how economic power is exercised, how risk is distributed, and how global integration is unwound. By Q1 2026, the shift is complete. The only remaining question is how long the consequences will echo. The most visible consequence of this shift is not diplomatic tension, but the slow, grinding reconfiguration of global supply chains. For 30 years, firms optimized production around factory gate cost. Labor arbitrage, scale, and logistics efficiency determined where goods were made. In the new tariff era, that logic has been overwhelmed by landed cost. Duties, compliance risk, and political exposure now dominate the calculation. Where something is produced matters less than whether it can cross a border without punitive taxation. China's role as the world's factory has not vanished, but it has been decisively narrowed. For U.S. bound goods, China is no longer the default. It is the risk case. The widening tariff differential has triggered one of the fastest redistributions of manufacturing capacity in modern history, not because alternatives are cheaper in absolute terms, but because they are cheaper after tariffs. The Risdit is Ruts AFR, NTICPOLIC, Migration of PROD UCTIT, Nunts ON into Southeast Asia, India, and parts of Mexico, each absorbing different fragments of China's former dominance. Within Southeast Asia, the shift is uneven but decisive. Vietnam has emerged as the primary beneficiary. It has captured the majority of market share lost by China in textiles, apparel, and certain categories of electrical equipment. Even with a 20% tariff, Vietnamese goods remain competitive against Chinese products, facing cumulative duties exceeding 50%. The arbitrage is simple and brutal. An upholstered wooden chair shipped from China carries more than double the tariff burden of its Vietnamese equivalent. Factories respond accordingly. Vietnam's industrial zones are operating at capacity. Capital inflows remain strong, and exporters accept the tariff as the price of admission. Thailand's role is narrower but strategic. It has positioned itself as an alternative hub for lower complexity electronics. Printers, copiers, and networking equipment now increasingly originate there, not because Thailand has leapfrogged China technologically, but because tariff exemptions and zero-rate categories make it viable. printed circuit boards and routers entering the U.S. from Thailand face little to no tariff friction, while Chinese equivalents are penalized heavily. This is not comparative advantage in the classical sense. It is comparative access. Malaysia occupies a critical niche in the semiconductor value chain. It is not fabricating cutting-edge chips, but it is indispensable in assembly, testing, and packaging. These stages are labor-intensive, politically unglamorous, and essential. Malaysia's advantage is reinforced by tariff asymmetries in medical goods and industrial inputs. Where Chinese products face crushing rates while Malaysian equivalents do not, the supply chain has not moved wholesale. It has fractured into politically acceptable segments. India's position is more complex. It is central to the China Plus One strategy, but it is not immune to friction. On one hand, India has seen explosive growth in solar panel exports as U.S. buyers scramble for non-Chinese suppliers. This reflects a genuine move up the value chain, from basic assembly toward more integrated manufacturing. On the other hand, Indian exports face a trade-weighted tariff rate exceeding 30%. Driven by geopolitical tensions and punitive targeting linked to India's foreign policy independence, including its continued purchases of Russian oil. Despite this, capital continues to flow into India. By WILLING tool, Song the TOLERATE kit of Hich TRIFFS, because the chess is GEOPOLITICALEXPORT, exposure S into the U-China. India's advantage is not cheapness, it is scale, demographic depth, and long-term optionality. Firms are not optimizing for the next quarter. They are hedging against the next decade. The physical movement of goods tells the same story in reverse. After the tariff announcements of 2025, importers front-loaded shipments to beat the hikes. Ports were congested, inventories swelled, and logistics firms booked record volumes. By early 2026, that demand has collapsed. Container imports into the United States are down sharply year over year, with double-digit declines forecast through the first quarter. This is not a cyclical slowdown. It is the hangover from a structural shock. Freight rates confirm the picture. Shipping costs have softened despite geopolitical instability and supply chain rerouting. Weak demand is overpowering logistical complexity. Tariffs are doing what they are designed to do, compress import volumes, but the compression comes at a cost. The logistics sector is shedding activity, capital expenditure is slowing, and downstream industries feel the drag. Trade policy has also shed any remaining pretense of being purely economic. In Q1 2026, tariffs are openly deployed as instruments of national security. The so-called fentanyl tariff exemplifies this shift. Supplemental duties on Chinese goods were justified not by trade imbalances, but by the alleged flow of precursor chemicals used in opioid production. This collapses the distinction between trade sanctions and criminal enforcement. Tariffs become punishment for behavior unrelated to commerce, bypassing diplomatic and legal channels. Objective is attainment by WILLING tool. Song the TOLERATE kit of Hich TRIFFS, because the chassis S. Market policymakers aim to reduce foreign exchange inflows that support China's industrial and military ambitions. This is decoupling without embargo, attrition without confrontation. Vietnam illustrates the geopolitical tension embedded in this strategy. Internally, Vietnamese leadership remains deeply suspicious of U.S. intentions, haunted by the history of regime change and so-called color revolutions. Leaked military documents reflect fears that economic integration could be a prelude to political destabilization, yet pragmatism prevails. Vietnam accepts tariffs, enforces transshipment rules, and deepens trade ties because the alternative is economic isolation. At the same time, Vietnam hedges. It upgrades its relationship with the European Union, emphasizing critical minerals, semiconductors, and trusted networks. The language is careful but pointed. Coercive trade practices are rejected without naming names. Vietnam does not choose sides, it builds buffers. The same dynamic is visible at the level of global finance. Threats against the BRICS bloc, including warnings of 100% tariffs for attempts to bypass the dollar, have had the opposite of their intended effect. Rather than deterring experimentation, they have accelerated it. Trade pressure has become a catalyst for financial sovereignty initiatives. Under India's 2026 chairship, BRICS is moving from rhetoric to infrastructure. The proposed BRICS bridge payment system aims to link central bank digital currencies, allowing cross-border transactions outside the SWIFT network. This is not an ideological project, it is a defensive one. If access to dollar clearing can be weaponized, alternatives become a necessity, not a luxury. The parallel system is no longer hypothetical. Platforms like mBridge are already processing tens of billions of dollars in transactions, dominated by the digital yuan. Even without formal Western participation, the network grows, supported by regional trade and energy settlements. De-dollarization is not replacing the dollar overnight. It is reducing marginal dependence, transaction by transaction. All of this feeds back into the domestic economy. Tariffs are taxes, and the evidence is clear about who pays them. By the end of 2026, the majority of the tariff burden falls on U.S. consumers. Importers pass costs through. Retailers absorb some margin compression, but foreign exporters largely do not. The average household experiences this as a quiet erosion of real income, equivalent to a tax increase measured in thousands of dollars per year. This is where the new tariff era becomes politically dangerous. It generates inflation without growth. It raises prices while suppressing demand. It introduces stagflationary pressure into an economy already constrained by high interest rates. The Federal Reserve faces a dilemma it cannot solve with monetary tools alone. Tariffs push inflation up even as activity slows, placing a floor under prices and a ceiling under policy flexibility. The promise was jobs, the reality is distortion. Manufacturing output may expand modestly over the long run, but those gains are offset by losses elsewhere. Construction slows under higher material costs. Services contract as consumers retrench. Net employment falls below baseline projections. The system does not reindustrialize cleanly. It reallocates pain. And beneath the visible economy, a shadow market flourishes. Tariffs imposed by executive authority create a scramble for exemptions. Lobbying explodes. Access becomes decisive. Firms with political connections secure relief. Small and medium enterprises do not. Bankruptcy filings surge, particularly in industrial and transportation sectors where margins are thin and input costs are unforgiving. This is not an unintended side effect. It is a structural feature of discretionary power. When rules are opaque and mutable, influence becomes capital. Survival depends not just on efficiency, but on proximity to decision makers. By Q1 2026, the contours of the new system are unmistakable. Trade is fragmented, finance is bifurcating, inflation is structural. And resilience has replaced efficiency as the organizing principle of global economics. The question is no longer whether the old order will return. It is how societies adapt to the one that has replaced it. The adaptation process is already reshaping entire sectors. Nowhere is this clearer than in industries where tariffs are no longer defensive tools, but explicit instruments of coercion. Pharmaceuticals, automotive manufacturing, and advanced technology have become battlegrounds where trade policy is used to force specific outcomes rather than correct market failures. The pharmaceutical sector was once considered untouchable. Drugs were treated as humanitarian goods. politically sensitive, and economically insulated. That insulation collapsed in late 2025. The administration openly threatened tariffs of up to 200% on imported pharmaceuticals, not to block supply, but to extract concessions. The message was unambiguous: lower prices domestically, manufacture locally, or lose access to the market. The response was immediate. Major pharmaceutical firms announced large-scale investments in U.S. production facilities. Novo Nordisk's multi-billion-dollar commitment to build in North Carolina was not driven by labor cost efficiency or logistical optimization. It was driven by the credible threat of exclusion. This marks a profound shift in how foreign direct investment is negotiated. Tariffs become leverage, not protection. The state becomes an active negotiator of industrial capacity. This model is likely to spread. Once policymakers observe that tariff threats can compel investment, the incentive to deploy them across other strategic sectors becomes overwhelming. The government moves from regulator to allocator, deciding which industries must onshore, which firms receive relief, and which absorb punishment. The automotive sector illustrates the hard edge of this strategy. The 145% tariff on Chinese electric vehicles is not symbolic. It is prohibitive by design. The goal is not to slow imports, it is to eliminate them entirely. This is a firewall around the domestic EV ecosystem, justified on national security grounds, but enforced through trade law. As a result, the battleground shifts to rules of origin. Under the USMCA framework, vehicles assembled in Mexico or Canada must meet strict content requirements to qualify for tariff-free treatment, U.S. Authorities now scrutinize these rules aggressively, looking for Chinese batteries, software, or subcomponents embedded anywhere in the supply chain. A single violation can trigger punitive duties, retroactively applied. This has transformed compliance into a strategic risk. Automakers are no longer optimizing for cost or performance alone. They are auditing their suppliers for geopolitical acceptability. Entire tiers of the supply chain are being redesigned to avoid Chinese exposure, even when alternatives are inferior or more expensive. Technology, particularly semiconductors, exposes the internal contradictions of the new tariff regime. On the one hand, tariffs and export controls aim to weaken China's technological base. On the other, they raise costs for U.S. manufacturers who depend on mature node chips. Legacy semiconductors are ubiquitous. They power cars, appliances, medical devices, and industrial equipment. Tariffs on these inputs ripple through the economy, raising prices in sectors far removed from high-tech competition. Paradoxically, the same policies have accelerated diversification in green technology. Solar manufacturing has surged in India and Southeast Asia as firms seek non-Chinese suppliers. This represents a genuine reconfiguration of supply chains, but at a higher cost structure. Clean energy transitions continue, but no longer cheaply. All of this feeds into a broader macroeconomic feedback loop. Tariffs function as a tax wedge. They raise prices directly and indirectly. Economic theory suggests that the incidence of tariffs depends on elasticity, but the empirical evidence from 2026 is clear. Consumers bear the majority of the burden. Importers pass costs forward. Retailers absorb some losses, but foreign exporters largely do not reduce prices enough to offset duties. The result is a sustained inflationary impulse. Goods prices rise even as demand weakens. This is cost-push inflation, not demand-driven overheating. It is particularly destabilizing because it limits the effectiveness of monetary policy. The Federal Reserve cannot cut rates aggressively without risking further inflation, but cannot hold rates high without deepening the slowdown. This is the essence of the stagflationary trap introduced by the new tariff era. Growth slows, prices rise, policy flexibility evaporates. The economy settles into an unstable equilibrium, where neither inflation nor stagnation can be fully addressed. Labor markets reflect this distortion. Tariffs are often justified as job creators, and in narrow segments of manufacturing, employment does increase. But these gains are offset by losses elsewhere. Construction contracts under higher material costs. Logistics shrinks as import volumes fall. Services suffer as consumers reduce discretionary spending. The net effect is negative. Employment ends 2026 below its counterfactual baseline, not above it. This divergence between promise and outcome is politically corrosive. The benefits of tariffs are concentrated, visible, and often symbolic. A reopened factory. A ribbon-cutting ceremony. The costs are diffuse, hidden in prices, margins, and bankruptcies. Small and medium enterprises, lacking pricing power or political access, are squeezed hardest. Insolvency filings rise, particularly in industrial and transportation sectors caught between high interest rates and inflated input costs. Behind the scenes, the shadow economy of trade policy expands. When tariffs are imposed by executive discretion, exemptions become the most valuable asset. Firms lobby intensely for relief. Spending on trade lobbying explodes. Success correlates less with economic necessity than with political proximity. Exemptions are extended quietly. Entire product categories are carved out for those who can make the right case, to the right people, at the right time. This creates a two-tier economy. Large firms with legal teams and lobbying budgets survive and adapt. Smaller firms fail. Market concentration increases, not because of superior efficiency, but because of superior access. Tariffs intended to restore industrial balance, inadvertently accelerate consolidation. At the global level, the consequences are even more profound. The weaponization of trade and the dollar forces other countries to respond defensively. BRICS initiatives are not attempts to overthrow the dollar. They are attempts to escape vulnerability. Payment systems like M-Bridge and proposals like the BRICS Bridge do not replace existing infrastructure, they route around it. Each transaction settled outside the dollar is marginal, individually insignificant, collectively transformative. Over time, they reduce the centrality of Western financial plumbing. They create optionality. They change bargaining power. This is the long shadow of 2026. The new tariff era does not merely raise prices or shift factories. It rewires incentives across the global system. Efficiency is no longer rewarded. Alignment is. Predictability is replaced by discretion. Integration gives way to blocks. For businesses, survival now depends on resilience, political literacy, and supply chain redundancy. For governments, trade policy becomes a permanent instrument of statecraft, not a cyclical adjustment. And for the global economy, the assumption of a single, integrated market gives way to a fractured landscape defined by walls, workarounds, and parallel systems. As the first quarter of 2026 closes, this is no longer a transition. It is the new baseline. The old order is not coming back, not because it failed economically, but because it failed politically. The system that replaces it is less efficient, more expensive, and more volatile, but it is also more controllable. That, above all else, is why it endures.